I must say, sometimes my worst investment decisions was selling too early because I got spooked. For instance, I bought McDonald's at a certain moment.
It's like doubling down on stocks where the valuation is cratering. If you've done the work and you have a good rationale for that, that can be like an incredibly powerful tool.
All right, so we talked about some of your favorites right now and your reasoning, but if you're an investor, you don't walk out, without some limbs missing and some some battle scars. Though
It's just smashing out cash. I mean, the cash is flushing against the walls everywhere. So, yeah, it was for me a no-brainer investment. Would I now buy a lot? No, it's more on the high end of the cycle.
For an advertising-free version of the show, check out patreon.com/Wall Street Wildlife. Hello and welcome to the latest Wall Street Wildlife with Christoph and Luke, and our special guest this week from the Dividend Talk podcast, Edgi, from Derek and Edgi's Dividend Talk chat. Derek and Edgi have an incredible dividend growth oriented podcast. If you caught our last week's episode, we reposted the interview that Christoph and I had on their pod. And now we're bringing Edgi back over onto Wall Street Wildlife to share some of his passion for dividend growth investing, explain what this thing actually is, and get into the nitty gritty about some of his own holdings. Edgi, welcome to Wall Street Wildlife.
Yeah,
welcome to the jungle.
thank you so much. And yeah, I've been lately also watching your videos. So kudos, guys. It's always good to help retail investors to, inspire them a bit, right? And hopefully for them to make better investment decisions. I have to apologize, Derek. I know how much he loved to be here, but I will not give the private reasons. But effectively, he is totally blocked from any engagement at this moment in the weekends, which I know is a bit more needed. So he sends his greetings to us, and he hopes that we have a great time.
Perfect. Well, why don't we kick off? And just in case our listeners haven't caught Dividend Talk before, why don't you tell us a little bit about who you guys are and the mission behind the Dividend Talk podcast?
Yeah, definitely. So, being a European, yeah, there's one thing that's really difficult, and that's building wealth. Yeah, we get harvested everywhere by the governments. And I was in my early 30s. At a certain moment, you have some money left in the end of the month, and I started to think what to do with this. And I felt like I need to start doing something because at that time in the news I was reading again, like, pension system is again 0% re-indexing. What that means is your future, the future money that the government would pay you when you turn 65 or 67 is staying flat, while inflation was 2-3%. Then I started to look up some data, and I saw, like, whoa, this is in 10 years I lost 20% of purchasing power. I felt like I will be poor when I by the time I reach retirement, which is another 30 years. So imagine that 10 years, 10 years, 10 years, all the time losing 20%. So that got me really into, to keep a long story short, into dividend investing. Then COVID came in 2020, and we were all bored sitting at home, and I was hanging around a bit on X, making a bit of memes, a bit of talking about dividend growth investing. And yeah, while you're bored, you say there's some friends on X that you're building up, and we said, like, hey, why don't we just go on cam one time and we just chat a bit with each other? And we started to talk for an hour, and we really enjoyed it. And we said, like, you know what, we should have recorded this. So, and from one thing came another. We just the next week we recorded it, and we just threw it on Spotify, and actually people started listening. We had like 100 listeners or something like that. We called it a pilot episode as a joke. And yeah, from there, it just started growing over the last 5 years. We have done now 260 episodes. The format is pretty much still the same as then. But our vision really comes back to my own need that I have. We want to empower just ordinary Europeans really to take matter in their own hands. We so happen to have chosen the dividend growth strategy. There are other strategies as well, but we find it important to kind of wake up the people in Europe and not just rely on your house that you can't eat and on your pension obligations. And I see it in my own family, where people that just retired, it is really not a lot. Yeah, I think honestly there's a lot of poverty there for people that have been working their whole life, an honest job. we may be more on high paying jobs, but there is a whole I mean, probably the majority of the country in the Netherlands, for instance, probably earns less than 2,500 euro or 3,000 euro, right? And if you see what the cost level is of housing and everything, it's hard to make ends meet. So that really inspires us, because without that inspiration and the community that we've built around it, it would have been very hard to do 5 seasons of Dividend Talks. So, and the community, I think, keeps us going, because we get on a weekly basis some people emailing or giving messages how much it means to them. What is good to know, if you think about the podcast and the community, it's it, it's a bit probably incorrect to say that those are people that only do dividend growth investing. There are people that have mixed portfolios, typically, but they come to us, they listen to us for that dividend growth part typically.
Can I ask you a quick follow up?
Yeah,
On your website, which is EuropeanDGI.com, you have right up front a short introduction to yourself, but then a little bar graph
yeah,
that says where I am on my journey.
yeah.
And currently you're at 72%. Can you explain that particular
Yeah, definitely.
stat?
And I need to update it, because I saw this week that it's 80%. So it's a bit outdated. Effectively, this means for me, the journey, how far I am when it comes to financial independence. What does financial independence for me mean? And what does the 80% identify? It is the, let's say, the dividend income that I get on an annual basis divided by my annual expenses that I have. So I call that the expense crossover point. So I'm now at 80% of that. And yeah, I still need to make 20%. And then I can technically call myself financially independent. I'm on purpose not saying retire early, because over the years, I noticed that I'm not a person that can sit at home watering the flowers. Yeah. So I will always do something, but it may not be in the same capacity as I would do it today.
Right, like Badger, that's all he does is sits at home and waters flowers and digs for acorns or whatever he does with it.
Well,
So,
but I'm jealous.
okay,
He's doing a podcast and such, and he can do it during daytime.
yeah, yeah, yeah. He's more than just a pretty face, a furry face, whatever. But hey, just a quick follow up to that ratio.
Yeah,
Just in plain English,
yeah,
just so everybody understands. I want to make sure I have this right. Everyone has expenses.
yeah,
That's some number.
yeah,
And then dividends are the call it financial instrument that some companies
yeah,
offer in which they literally pay you money.
yeah,
And you're saying that you have your expenses and the amount of money you get from all your companies,
yeah,
when that is a 1-to-1
yeah.
ratio, that's what 100%
Yeah,
would be. Is that correct?
exactly. The dividends are paying 80% of all my life expenses. This is not, and that's very important to say, because some people, I know, they make mistakes there. It means for me also budget reservations for replacing the roof in 20 years, car payment reservations for if I want to buy a new car in 5 6 years. So all of this is included in what I call my budget. And I'll make sure that before I am at 100%, that I also have a bit of a margin of safety. We'll get maybe a little bit later to what a dividend cut could do, for instance, to the income. But also, it also means like an emergency fund of 6 months of living expenses.
That's good. That's really prudent. And that's like really encapsulates well, I guess, the thought process of many investors who pursue dividends as a core part of their strategy. I guess you guys aren't just about dividends, and you course corrected us when we were interviewed by you, because I said, oh, dividend stocks are boring. And you're like, we're not dividends, Luke, we're dividend growth. So do you want to expand on that aspect? What does it mean to be a dividend growth investor?
Effectively, it is the recognition that a company needs to grow first before we want to get a share of their profits in the form of dividends. Because if we would focus on the dividend first, we are very likely to experience income loss, salary cuts, as I call it. So I see income as a salary, to me. And that's something that's the most painful to have, because if you are, let's say, living off that money, the last thing you want is your money to disappear. Yeah. So for me, it is important, therefore, to always look at the growth first of a company, because if a company is growing both top line and bottom line, then I would say the probability is higher that they can continue affording and to pay a dividend, and that's very important. And therefore, it is not just looking at the dividend yield and such. We really need to study a business to understand, can it effectively pay a dividend going forward, a growing dividend going forward.
To maybe might be an interesting moment for me to talk a little bit about my own beginning journey in investing. Badger, I don't know if I've ever told you this, but when I was 17 years old, that first Motley Fool book that came out, God, it's so long ago now, but they had a formula. It was like they took it was some formula in which they calculated, call it market cap, and then they had dividend yields, and then some basic ranking of, you should purchase these four because these four have the most reliable correlation between dividend and maybe beaten down by the market or some such thing. Foolish Four, maybe it was called. And back in 1997, I guess before the advent of all the computerization, I read that book as a 17-year-old. It was like, oh yeah, this makes sense. Buy beaten down companies that pay you a lot of money, and that's a sure way to victory. And then not long after that, it was debunked statistically that it's too simple a formula, or the world got more complex, or whatever. So I'm glad I mentioned that, only because I think many dividend people brand new to the game might say something as simple as, why not just invest in the companies that pay you the most? So make it as simple as rank them by dividend yield, but it's just way trickier than that.
Yeah, and there's an irony to it, because many people that call themselves a dividend growth investor are all in those yield max ETFs, trying to score a 12% yield, which is effectively what they're getting as option income, yeah, from the ETF, and they call those dividends because it's distribution. And for me, that is really something that really stands like 180 degrees from my own philosophy. And yeah, because that's for me yield seeking, and seeking typically lends, how is it, ends up in crying.
And you do own a bunch of dividend stocks, and you talk about on your own podcast, like stocks that pay actually quite a small dividend. And I guess there, the growth component is quite important. Like, how do you kind of rank and stack these things? Let's sort of pair it back to, because we're kind of pure growth investors, and it's almost coincidental that Christoph and I sometimes own stocks that pay a bit of a dividend, but we're really looking at like earlier stage companies. Like, how would, like, maybe try and persuade our listeners, like, why is owning dividend paying companies also a kind of profitable, beneficial strategy as an investor?
Yeah, and I think what we need to maybe land on first, like, what's the ultimate goal of investing?
Hmm.
Yeah. So for some people, the ultimate goal of investing is to have the maximum total return out of their money invested. For me, it's not. For me, it's replacing my hard-earned income that I put a lot of sweat in by passive income. Let's call it like that. For that, you have multiple strategies. You can do dividend investing or dividend growth investing. In my case, you can do real estate investing and such. So it's really important to know that I'm not focused on total return, but I can tell you that total return is typically an outcome of also of my investing style, or a good outcome. And there are enough statistics actually about it when you think about dividend growth investing. And I will share maybe a picture with you as well, where it's clear that dividend growers and initiators are outperforming by a wide margin all other companies with other dividend policies. So just dividend payers, that if you think about, I have a picture here in front of me from 1973 to 2023, are maybe only 60% of the total performance compared to the dividend growers. And then you have the no change in dividend policy that effectively do nothing. They are really lower. I always say in this, like, it's a market of stocks. It's not a stock market. So we should not generalize on this. But I do think that dividend growth companies, they are typically very cash rich. So if you think about capital allocation, think about Google, Microsoft, Facebook, because for instance, Meta and Google recently started to pay a dividend. I think there are two reasons for it. at a certain moment you earn so much cash that you may not be able to reinvest it anymore in your business with a certain amount of return. So that's better to just give it back to the shareholders so that they can reinvest it elsewhere at a better rate of return. Or maybe in Meta's case, it is much easier for Zuckerberg probably to get a dividend than to borrow money against his shares. Yeah. So what I would like to say is like, for me, it is much easier to predict if a company can grow in the next few years for a little bit more the established companies, the blue chip companies. I often understand their products. These are slow compounders, and it's really important. I'm a big fan of slow compounders. Slow compounders for me are companies that take like 20 years to build a business slowly because of the market dynamics. It's really hard to compete against them at a certain moment. Think about Amazon, a perfect example of a slow compounder. It's not easy to just beat Amazon at their home turf, right? And start taking market share from that. The same with Microsoft, but the same with Unilever, the more classic dividend growth stocks that we're talking about. So for me, they are much more predictable. There are enough warning signs if these companies are starting to turn south. And it makes it much more easier for me to analyze, to understand the business, and to kind of predict a little bit because we're all in the business of prediction here. What is the likelihood of the company doing better, let's say 5 to 10 years from now, than where it is today? So that's where my character comes in, that I find it easier to analyze, and that's why I'm not so much in the early stage. But I guess the risk and reward is also different. I think making a 10 bagger with Microsoft is a bit hard at this stage of the journey, though. I think people would have said the same in 2014, when I bought the stock at 40 and now it's a 10 bagger. So you never know how a stock still evolves, but I can tell you it was not in my predictions at all with Microsoft at that moment in time. It's just one of those companies that blows up in your portfolio that you think like, okay, I sound smarter now than I was in reality at that time.
Yeah, Edgy, I loved a couple of definitions you just threw out, that what the business that we're in is the predictions business. That's an interesting frame, which is true, especially when you correlate it with risk. I want to ask you one follow up about this broader question of what is investing. I think Luke and I always talk about investing as something that is a personal journey, and it sounds cliched. Every time I say it, it sounds almost like a Hallmark card, but I think it's a cliche for a reason, because there's so many variables in each and every individual person's lifestyle and makeup and where they live and who they are, all these things, that there is simply no such thing as an algorithmic one size fits all. And the question I want to put to you is specifically relating to, call it, life cycle stage. Would you say that dividend growth investing, or your style of investing, is more or less loosely applicable across different life cycles, life?
Yeah, I find that hard to answer, Christoph, because I don't like to stereotype a little bit. Like when is a, some people say, when you're young you should take more risk, you need to be a growth investor. I much more resonate with your first comment, is that it's personal. So if I go personal here, yeah, I come from a poor family. I had no money. My mother was broke, in poverty, social welfare. Um, we were hammered with debt out of a marriage. We literally were on the Dutch equivalent of food stamps. So if I went to study only because I got a scholarship from the government, if I had to pay like nowadays students for study, I wouldn't have paid for it because I was debt averse. So for me, naturally, a conservative style that is focused on maybe, let's say, boring predictability, cash flow, is just much more ingrained in me. I'm just more averse to risk from that point of view. To make a few bets like Bitcoin and such, because you could say from a total return investment, if you want to get the best total return and you look back over the last 10 years, you should throw all your money today in Bitcoin. Yeah, if you think like that. But that's not me. So it's very personal what people choose. And I know people that are my age that are just throwing everything in specs, biotech, and everything because they just like the gambling part a little bit of it, but they also don't want to wait 10, 12, 10, 15 years for a slow compounding portfolio. So I resonate more with our character styles. And what I always say, don't take dividend growth investing because you hear Derek or me talking about it. Find something that fits your character the most because you will probably do the best naturally. Yeah, you are not fighting against yourself with such an investment style.
And there are so many benefits from doing that. Like, you essentially get all your research for free because it's something you actually, it's a subject you're interested in. And
Exactly.
if you really kind of, not, I'm going to use the word like believe in, I don't mean like a sort of religious belief, but if you really support the mission of the company, if the company is executing, but the stock is struggling, well, that could be a good opportunity to add as opposed to
Hmm.
panicking and selling. And if you're really behind the mission of the company, it's going to help you stay the course when things become
Yeah.
kind of scary, when your stock prices are down.
Yeah, what we always say in Dividend Talk, and we are famous for two quotes. One is you can't borrow conviction. Yeah, in the end, it's your money and you're alone with it, and it is very lonely. And the second one is bankers are wankers, but that's another story.
He's teasing me. He's teasing me because I'm an ex-banker.
You redeemed yourself though, Badge. You're on the other side of penance. So we're okay. We've done our intros. Let's talk specifics.
Sure.
It's some of these stuff is it's harder, until you get to the nitty gritty. Can you walk us through one of your highest dividend growth investment conviction picks?
Yes, and I was thinking like highest conviction if I would buy today. Yeah, so my portfolio is already 10 years old. So I just want to talk about a company that I just initiated a position in this week, and that's Euronext. Are you known with this name, both? No?
I know the name, but I couldn't tell you
Okay.
what they do. Yeah.
So Euronext is effectively operating in most of Europe, most countries of Europe, the financial market in terms of brokerage and everything. So they are really doing the clearing for the brokers. So if you use interactive brokers, the Hero, and you want to buy stocks in the Netherlands or France, it's all being processed and cleared via Euronext. Now, I did a deep dive on this business not too long ago, and I really started to see why this company has been growing with a 15% CAGR over the last 5 to 10 years. Reason for that is that there's a lot of consolidation opportunity in Europe. So when you look at it, at the moment, they own the stock exchanges in Paris, Ireland, Netherlands, Belgium, Italy, and Portugal, and a little bit of Spain, but not yet of Frankfurt, right, where we have Deutsche Börse, not yet of Warsaw. The Nasdaq is owning a few in Stockholm and Helsinki. And if you think about what's going on also in the European Union at the moment with the policies, there is more of a trend, specifically after the wake up that America gave us, the wake up call, to start being more investor friendly. There's also the faster procedure that will come in 2027, which makes dividend reclaim and withholding tax reclaim much more easier in Europe. So there's a lot of favorable policies at the moment that allows Euronext to continue acquire companies, let's say, and consolidate. They've been also in the past they weren't doing much of the clearing. They had a few deals with clearing houses, and now they are in Europe kind of owning almost all the clearing in the countries that they operate. So there's a very fragmented market. I can share also a picture of how that looks like. And they've been consolidating over the last 10 years since its IPO, and I expect it to continue consolidating. So there's a lot of growth in this company, which I really like. So if you think about it, in 2014 they had 500 million in revenue. Now they have 1.7 billion in revenue. That's in top line. That's quite a decent run, right, for the companies that are available to us in Europe. And they still get 34% of money from trading revenue. But they are more and more expanding the services, like I mentioned, clearing and such, and fixed income to how is it, to make less dependency on that. Actually, at this moment in time, I think if there will be a global crisis or economic crisis or in Europe, it will do the company well because I expect more trading to happen. So it's also a bit of a hedge at that time. But then if you look at the net profit margin, the gross margin stands at 48% and 38% at the moment. So we're not talking here about a thin margin business. EPS has grown from 169 in 2014 to 563 in 2024. So it shows you the growth. Cash flow wise per share as well, from €2.05 to 666 right now. Yeah, and the dividend has been growing in lockstep with that, about 12%. So for me, this is an example of a business that is growing really nicely. And if you then ask me, what do I look for in such a company? What boxes does it need to tick? Because I think that's important. Because for me, it is mostly about the dividend safety and the valuation of a company when I want to invest, because I'm a bit of a Scrooge. I don't like overpaying. Yeah. So when you think about it, I first need to see that the company is growing. I think clearly Euronext is doing this. Secondly, can it continue to grow? Yes, I think so. There's a lot of consolidation opportunity. Does it have a healthy balance sheet? Yes, it has. However, it is becoming a little bit less because, with the form of acquisitions, more and more goodwill comes on the balance sheet. So the return on capital employed has been decreasing a bit. But if you look at the investments, the return on invested capital is still outweighing the weighted average cost of capital. And management also wants to see that when they acquire a business, and they just acquired the stock exchange of Athens from Greece, they want to see that within 3 years, the return on invested capital is far away outweighing the weighted average cost of capital. And they do that via synergies and all these kinds of things. And so far, they have a good track record. A fourth element for me is like, are the payout ratios reasonable? I don't like really companies paying more than 60% of their earnings or free cash flow in dividends, because then then they don't have money to invest for growth in their business typically at that stage of the life cycle. And then the last question that I ask myself is, the management committed to the dividend? Because in Europe, we have a lot of companies that pay a 50% payout out of earnings policies, which I think is better maybe than the equivalent in the United States, where it's sometimes about growth, dividend growth at all costs. Yeah, we can maybe come in later to that back. And Euronext ticks all the boxes here. Just maybe on the valuation, it's a bit on the rich side for me. So what I mean, like, I anchor it at a certain level. I think it's 10% overvalued now, but for me, it's the range that I typically want to initiate a position if it's a good business, because sometimes I'm too conservative with my discount rates or something like that, and I see that companies just outperform my own thinking. So Euronext is one of those companies that I really have a lot of conviction built in lately, but it's still an initiating position. So for me, it now means like studying their quarterly reports a little bit more, let it grow on me. I never go full into a position from day one.
What is a full position for you? Like how have you said you've just added?
So now it comes a bit to portfolio allocation strategy. I have about 50 stocks in my portfolio, and I have like 4 tiers. So tier 1 are my anchor stocks, and then you go all the time a little bit down. And I'm not using the efficient portfolio frontier. It's too complicated for most of us here to really be like a quant modeling your portfolio. So I started to think totally backwards. I started to think like, okay, let's assume a company goes out of business or cuts the dividend entirely to zero. What do I feel comfortable with? I said, well, maximum 4%, because if my dividend grows on average 6% to 10%, if one company goes bust, the rest will lift it up. So that's my thinking. So tier 1, maximum 4%. And then I thought like tier 2, probably a little bit less of an anchor, still high quality businesses, 3%. Tier 3, 2, 1%. So for me, Euronext is now in the tier 3. I never put it straight away into a tier 2 or 1. I need to learn about the company more because I may be wrong, and I've been wrong before with such kinds of bias.
Edgy, since this is strange to say, but we're all Europeans here. uh,
Yeah, but I think you live in the US, so I don't know if you're familiar with the businesses here.
if most of our listeners are in the United States, is a stock like Euronext
Yeah.
easily?
CME
Uh,
Group, a little bit of S&P Global potentially, but they don't. I don't know if they own a stock exchange. I don't think so. So it's probably CME Group and MSCI. So I think those are the equivalents. Those are typically the stock exchanges that you're looking at. In London or in England, it's the London Stock Exchange Group. Yeah, effectively, if you buy stocks at the New York Stock Exchange, yeah, who owns that? Is it CME Group or MSCI? I don't know exactly. Nasdaq. Oh, Nasdaq is also such a company.
so what's the ticker that
For
what's your next?
Euronext, uh,
Yeah.
ENX.PA if you go to Yahoo Finance.
And you said that's come in at like tier 3 because it's a newer
Yeah.
investment. Can you just give us a flavor of your anchor stocks, which are your
Yeah,
highest
let
conviction
me
right now?
quickly pull it up.
Yeah.
Um, so obviously it's things like Microsoft in there. I think this company is simply brilliant and how it's operating. Then I have Johnson & Johnson in there, L'Oreal, um, insurance company like Munich Rückversicherung. It's a German one. They are the global reinsurer of insurers. So it's kind of an easy business, I would say. I've got ASR Netherlands in there. It's a Dutch insurer. So those are some of those in the tier one. Then if you go to tier two, I've got things in there like Iberdrola, Snap-on, Texas Instruments, LVMH, Apple. Yeah, and then downwards.
I did go and I had a look at a bunch of companies you guys have been talking about in recent podcasts.
Yeah,
I did take a look at Iberdrola because you both seem quite
yeah,
positive on it, yourself and Derek. They own Scottish Power in the UK,
yeah,
and everybody Scottish Power has a really terrible reputation in the UK.
yeah.
So that kind of put me off.
Yeah, so that they're well diversified enough, but I think it's a hydrogen play based on climate change. But that's the funny thing, right? Because there are like someone told me the other day about Planisware, a French company. I hate it as an end user, like SAP. Who likes to work with SAP? But then you look at the company, everyone hates it, but try to compete with SAP. That's nearly impossible. They're so ingrained in the corporate companies, and there are companies that try to move away from SAP, and they were like hovering around bankruptcy, yeah, because suddenly all the invoices stopped and the cash flow stopped rolling in. So yeah, there are companies sometimes that we all hate, but may still be very good investments.
Hey. All right. So we talked about some of your favorites right now and your reasoning, but if you're an investor, you don't walk out, without some limbs missing and some some battle scars. Though my suspicion is that my battle scars as a growth investor and badgers, maybe not to the same extent as me, are less than what you have.
Well,
However,
well, 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 you know.
tell us about something that really exploded and that backfired on you, and what
or,
lesson
or
did
that
you learn?
never exploded. Yeah, that's
Oh, great.
that's more of it. So there are two that straight away come to mind: General Electric and Tupperware. And maybe it's the most interesting to first talk about the second one, because we know Tupperware specifically. When you're a German, everyone knows the Tupperware parties, the plastic boxes effect, and of course, no, my generation, the millennial generation, doesn't buy that crap. But then you watch CNBC, and suddenly you see a CEO there, Ricky Goings. And by the way, there's something with names of CEOs in the companies they operate, right? So Ricky Goings. I mean, he's the one on a cocktail party that will sell you his mother-in-law. Yeah. So he was talking about like, we are going to empower the women in Indonesia. They're like, it's a country with, I don't know, 300 million people. Indonesians are not Indonesian ladies. It's hard on the job market, but they can become a freelancer by selling Tupperware. And I felt like, yeah, company is very poorly valued, and that's good valued for me, right? But this was a value trap in all sense, and there were no Indonesian women throwing massive Tupperware parties, but the dividend was like 4 to 5%. So I felt like, I've got a safety net there. I sold on time. So I didn't. Well, maybe I made on a $50, I made a $5 loss. But for me, the whole learning in that was so rich. Now, if we go in terms of dollar value, then I need to move to General Electric, another charlatan. Was it Jeff Immelt, the CEO there? My God, what a person. If you heard him talking also on CNBC, I mean, he was like, I think the only thing, I mean, when he left the company, even, he got a whole contribution from Harvard Business Review to write a full article as a captain of industry to share all his learnings in legacy. I mean, the company went literally to shite under his leadership. They were cooking the books. Have you read by any coincidence the book The Lights Out? It is a kind of a documentary on General Electric, and effectively what they were doing, these guys, and it shows so much about management. Every quarter they were just quickly selling a business of 100 million to cook up the books so that the earnings were predictable and everything. Now,
Mm.
next CEOs come in, stock keeps on dropping. I think 2 or 3 years ago, I really like the new CEO. He came from Danaher. I forgot quickly his name, but I felt like, no, this company is beyond repair. So I sell it at in December for tax harvesting, literally per 1st January. One rocket up General Electric. I think it went 5 to 10 fold since then. I could have made a profit on General Electric. I hold it for 4 or 5 years. A dividend sucker, a dividend cut, everything. And then at the moment I sell it, I get loss on my position. It goes 5, 6 times. And I must say, sometimes my worst investment decisions was selling too early because I got spooked. For instance, I bought McDonald's at a certain moment at $90, 5% yield. It went to $120. I thought it was overvalued. Everyone started to hate around me these kinds of menus. It was not healthy, this and this. And look at it now. Every time when I walk into a McDonald's with my kids, I mean, we don't find a place to sit. And it every time makes me grumpy because it reminds me that I sold it for $120 at the time. So these are the kinds of investment. And I didn't even start about Bayer that bought Monsanto for 60 billion, the worst deal ever. They Bayer is now less worth than 60 billion, maybe 30 billion or something like that. And they still have, I don't know, 10 to 20 billion of litigation ahead of it. It's out because of Monsanto and the Roundup cases. So there you go. I've got my I've got my track record here. But what I do say is, over time, and I think that applies to hopefully many of us, and this is what also Warren Buffett said. Over time, you need to figure out how you can make less of those mistakes, and I think then you will start to compound more and more. And I have a feeling that improving my strategy to even more and more study and focus on dividend safety and going not so fast into stocks has been helping me avoiding costly mistakes. So I still make them from time to time, but it's getting less and less.
It's a tough one, like managing your emotions when you sell out of the position and then the stock goes
Oh
bananas. Like
boy.
that happens to all of us. It's a weird one because you haven't lost anything, but you've kind of missed out on a gain. So it's kind of, you're emotionally torturing
It's a
yourself
fear
by
of
going,
missing out. Yeah.
yeah. But I mean, I try not to torture myself. I try and make what I call no regrets decisions. If I
Yeah.
decide to sell something, I sell it full of the knowledge it might go on to,
Yeah.
multi-bagger, and kind of so be it. I made the right decision at that point in time. But if you keep going back and like picking at that scab, like it's
Yeah.
never going to heal. Yeah.
No, and then
Yeah.
once it's out of my portfolio, I don't look at it anymore, but it comes back in these kinds of conversations. And I'm not a psycho, so I do have my emotions. Yeah.
Right, the ghosts of companies past. Yeah, I mean, that one hack is you actually delete, the company you sold from all your tracking
Yeah,
software,
exactly.
whatever. But no, there's no, you can't not drive past the McDonald's. I mean, you could actually if you you could take out of the way
Yeah,
routes,
but
but
you
that's
know as
going to
well, if you run a podcast, how often do you get this question about your losers? So also the community continues to remind me about this.
Hey, listeners. My name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, We cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
Speaking of losers, when we went on your show, we thought you have a great idea, a community portfolio, and you ask your guests to kick out a company and to explain why. And I show up banging my, I'm like, Shell, what a piece of shit, that old dinosaur ruining the planet. And you're like, that's my second largest position. But we never had a chance to follow up and for you to educate us on why we're wrong to suggest that's a loser. So what's going on with Shell?
So, well, it's probably good to know I'm long oil, first of all. I think that society is underestimating the impact and the reliability that we have on oil. Even if is it the EIA, I think, this oil agency that writes these reports about peak oil, they have been more wrong than right. And I just see this misconception. I think there's a desire for us as a society to move away from oil. And I think that influences our thinking also when it comes to investment decisions. But what I just continue to see is massive profits coming out of the oil business, and I don't see them to go anytime soon. If you, also, I mean, guys, because you just drive a Tesla doesn't mean suddenly that we don't need oil anymore. Oil is everywhere in life, and commuting is still a low part of that. And let's not even forget about the side products of a barrel of oil. I mean, your Tesla is still going over asphalt. Yeah. So your Tesla still is built based out of oil products. So taking that into consideration, you get oil stocks being very lowly valued in terms of multiples. There's a catch there because it's cyclical. So sometimes you can be misled by the multiple here as well. But what I think is good to know, first of all, I don't know it exactly, but Shell's probably trading at in between 30 and 35 euros. My average cost is around 19 euros, I think. And I've been buying after it cut the dividend, which is also maybe very interesting to speak about. In 2020, I've been actually doubling down and I've been buying stocks at 12 euro per share. So I've got a lot of profit in this, first of all. So a lot of capital appreciation as well. There's a new CEO in town, very aggressive on buybacks. They are having a buyback yield at the moment of 8% already for 3 or 4 years. They've been growing the dividend last year for 4%. So actually, we haven't spoken about buybacks at all as a capital allocation decision here. But I'm a big fan of buybacks done well. So in this case, you get an 8% buyback yield at this point in the cycle. Effectively, I would say they are break even somewhere between $40 and $50 of oil. Going below that happened for a few months during COVID. They had to cut the dividend there, and I was very supportive to cut the dividend there because they didn't cut the dividend since the Second World War. They in 2016, what people often don't know, there was a major oil crisis, an oil glut in the industry, but that was only particular to that industry at that moment in time, and it came because America became kind of oil independent and the OPEC lost its mojo, let's say. So it was already struggling since 2016. We saw that it was not sustainable. We wanted it to be cut, at least now. Okay, maybe that's a bit overreacting. It's easier to say it later, but at least I was expecting it to be cut sometime. 2020 just came too early for them to clean up the balance sheet. That's why there was and then I would double down because for me the bull case was still there. So yeah, now a few years forward, 5 years forward, it's just smashing out cash. I mean, the cash is flushing against the walls everywhere. So yeah, it was for me a no-brainer investment. Would I now buy a lot? No, it's more on the high end of the cycle. So you need to invest anti-cyclical when it comes to these oil and gas stocks. But I don't see a reason why it can't continue growing a dividend by 4%. That's their portfolio. That's their policy over the next 20 years, all else being equal.
That's great. And there's something really interesting there because it's like doubling down on stocks where the valuation is cratering like if you've done the work and you have a good rationale for that, that can be like an incredibly powerful tool. But if you double down on a losing stock just because the value's gone down and you haven't done the homework, like often that's an easy trap to fall into,
Yeah,
and often
it's a
that's a
falling
mistake.
knife. Yeah.
Exactly. But the nuance is like your rationale. So maybe coming out of stocks and talking about like your methodology and your thinking, like that's a common one, doubling down on your losers. And, really we want to be adding to our winners. But as a dividend growth investor, are there particular mistakes or value traps that say a lesser experienced dividend growth investor might be prone to?
Yeah, and I think they're similar to the growth investing style as well. So, for instance, simply not understanding the business that you're investing in, and buying stocks because you see them mentioned on social media, not knowing how to read the three financial statements. You must, of course, specifically to dividend investing. I'm particularly saying not growth in this is yield chasing. Yield chasing. I think we've all been victim to that. Actually, sometimes I even do it still, but that's more influenced by the the income factory book. So yeah, but still, I tend to look at dividend safety there. So yield chasing for me is that you go for 7+% dividend stocks there, and there, for instance, a really nice picture from AG Bell. I think is that a bank in the UK? AG Bell.
Yeah, like a broker. Yeah.
Yeah, exactly. I will share the report with you. But for instance, they say many dividend yields compare well to gilts. Yeah, and they show a picture of 10 stocks there from the UK. Only 4 out of them didn't have a dividend cut in the last decade. Yeah, but these are all high yields. So legal and general 8.6% yield, but never a dividend cut in the last decade. Then you have Phoenix Group, 8.5%, but it cut the dividend twice. So yield chasing is a very clear one that I think many starters in the dividend investment community get there, because one of, if you have a strong desire to become financially independent, then yeah, my portfolio yield is 3.8%. I could stop working today if I start buying high yielders tomorrow, and my portfolio would yield 5 or 6%. I can stop working, but I don't like the risk element of that, and yield chasing is one of those parts of that. But for the rest, it's just like value traps. Yeah, I think that's a big one.
Edgy, could I ask you to sort of let me try to translate that into maybe like a moral of the story. On the growth side of things, when I say if something is too good to be true, it probably is. I've learned from experience that that's not the case because uh, when you get companies that are 10x or 100x and you start on the journey early, you kind of have to have this almost optimistic, overly optimistic vision of what could be. Whether they make it or not, that's life, and there's lots of things that that's not a good moral. But on the is am I hearing you correctly that when an investor who's new to the dividend style investing, if they simply look at the highest number, highest dividend yield, that if it's too good to be true, it probably is? Is that
Yeah.
a reasonable sort of mantra?
I would say anything nearing a 10% yield, you need to do so much due diligence. Because let's face it, what are we talking about when we say 10% yield? Then we are saying that the multiple of the company, if you inverse it, can't be more than 10 times the profit. Yeah, the market cap to profit cannot be more than 10 times, because and then because it inversely you get then a 10%, let's say, dividend yield. I guess I'm talking more about shareholder yield, which probably suggests that they are paying out more than they are earning. Yeah, so you really want to stay away from those companies. Those are very red flags. It can, that's why I mentioned just before with Shell cyclical stock. They will look totally different at the bottom of a cycle. That looks like it's horrible to invest in. Yeah, but in the top of the cycle they look undervalued. But generally speaking, yeah, you're right. When it's a 10% yield, all your alarm bells should be ringing, and you should really understand what the hell is going on there.
So Edgy, I I've been waiting for this part during this whole conversation. I listened to an episode of yours, I think a debrief that you guys had after Luke and I were on your show, and this is a paraphrasing because I don't remember exactly what you said, but it was something like, "How the hell does Christoph sleep at night? That lunatic."
Yeah, exactly.
Like, and I found it so interesting because, of course, there we're talking about risk. I mean, it's really a conversation of risk, and I think risk is such a fascinating phenomena that all investors have to look square-eyed, dead in the eye at some point or another, and you think you understand it, but you really don't. What's fascinating to me is that in that time frame, uh, Badger brought Novo Nordisk to our community, and we were discussing it. I did some technical analysis over it, like outside of fundamentals. I painted pictures with crayons showing the chart going straight down. And at some point, it was just fascinating to me when I looked at the chart. It was at one point something like a $450 billion company. And then it dropped to something, I don't know what the recent low was, 200, sub 200. But so that was a loss of something like $250 billion in market cap. And I thought to myself, oh, who's the risk taker now, huh? Like, I don't go around losing $250 billion overnight. And so I'll turn it over to you. How do you, from your vantage of dividend growth investing, think about risk in the context of owning something like Novo Nordisk?
So first of all, there have been a lot of people crying there, and you know, which is we shouldn't laugh about, of course. But and I always get reminded about Warren Buffett. I think he said it like the stock market is what do you say? That where wealth transfers from the inpatient to the patient. So for me, Novo Nordisk has always been very much overvalued. It was not worth buying it at 450 billion, because you're right. There's a lot of risk involved because Ozempic and Wegovy together are like 60 to 65% of their revenue. Yeah, so effectively you have a single product risk in this company, which is huge. Um, so actually, we agree there. Novo Nordisk is a darling in the dividend growth community, but there's a lot of home bias there. We have a lot of people from Denmark, the national pride. So I take it much more in that corner. I never bought it so far because of that risk associated. But when it came down all the way, I started to nibble in. And I mentioned already, like before, my portfolio system, how I deal with it. These stocks are not more than 1% of my portfolio if you own 50 stocks, right? So I think the difference between what we felt, what you are mentioning, is that if you own a few stocks and you lose one stock on everything, yeah, I wouldn't sleep well at night. But I've got 50. If Novo Nordisk goes to zero in my portfolio now, I will have it in my. It will live rent free in my head. Like how I could have been so stupid, but I will still pop open this LVMH champagne bottle that I have standing here at the same time because of the dividends coming in. So I think that's where it comes down to. Now, why I started a small investment into Novo Nordisk, because I felt that the market started overreacting to some extent, a little bit overshooting. But I have also not full conviction because management has proven to be really stupid over the last 2 years. But they replaced the CEO. If I'm not mistaken, they forgot to file for the patent in Canada. I mean, oh my God, you must have really a plate of steel in front of your head. Um, then they had supply issues. Yeah, their drug was too popular due to their own marketing as well, that there had to be an emergency policy in the US to allow compounds, generics, so let's say copycats, to allow them to produce and sell it to the market, undercut their pricing. They come back in May. Yeah, and then it comes down to what we always say in Europe, right? If you're a European company in America, forget about the government supporting you. Yeah, so now they are suing all those copycats and everything to make sure that they can't sell that drug anymore. And that's very important for me because if patents are not protected anymore, it puts a bomb under the whole market. The good news that is now coming out in the last few days is that they are suing a lot of companies. Already 44 copycats have stopped selling. So Novo Nordisk is doing now the right things. But this whole story tells you already how much risk is associated to it. And anyone who tells you that they can predict here what's going on, I take them with a grain of salt. If you read on social media, there are all those people that predict it, but you need to be an insider, specifically in pharma companies and everything. That's really hard. But this is what is for you. Maybe, I don't know, the hottest new startup. For me, Novo Nordisk is spicing up my portfolio now.
I've owned this one since like this year, and I added to it quite recently, just a week or two ago, and then disclosed that on our Patreon trades channel for like all the reasons you described. Plus, also like Eli Lilly and Novo have both got oral weight loss drugs in the pipeline coming out soon. They're in like final phases of trials. So like instead of having to inject yourself with these things, you just take a tablet every day, and that's going to cause the market to explode. Like I've got personal friends who are on Ozempic, and like there's such untapped demand for these drugs, and as the costs come down, like they've recently agreed a deal with GoodRx in the US. I think that's why I added, because they've cut the price of Ozempic materially. It's down by like 50%. Like there's a huge untapped market, and they've made these mistakes with the patents, like you said, and now they're so clearly aware about how important these drugs are. They're not going to make those mistakes again.
I think this company has no experience with scaling a business, and that's what happened. They won the jackpot, they didn't expect it, and suddenly they needed to be like a startup. Yeah, and they are not. So and that's why I think they made failure over failure in the last year.
Yeah, good observation. I wonder if we could sort of use that thinking a bit, because like you said, they're almost like an income stock, and they had to go back to like a growth mindset. And I wonder, so like Novo Nordisk is one of the few income paying stocks in my own investment portfolio, even though Christoph thinks it's risky as hell. I think it's like super low risk. Are there, so, you've talked about some of like the legacy tech companies like Microsoft that you own. Is there anything on your radar where it's not an income paying stock, but you really like the company? It's more in like our world, where you think it might be something you'll be adding to your income stocks in the future?
There's one company that I could imagine that starts paying a dividend in the next 5 years, and that's Amazon. So it was the same with Meta a few years ago. It was clearly on their website, we will not start paying a dividend. And I felt like, yeah, but you need to do something with your cash. Suddenly they started paying a dividend. I could imagine the same with Amazon as well, but I still think it needs a bit of time, because they're too much dependent on AWS for the real bottom line profit. So maybe the logistics business, I saw a really nice picture where it's predicted to to earn more in terms of sales than UPS in a few years from now, which is very interesting. Yeah, to again another industry that they're disrupting. But I think Amazon could become a dividend grower in a few years. All these companies at a certain moment, they become too cash rich, and then they need to ask themselves the question, what are we going to do with that cash that we have left over that we can't get a reasonable rate of return on? And I think Amazon will come there soon. Not early growth, right? These are, I would say, already in the cycle for dividend growers.
Well, certainly not a boring company, which is how we characterize some of your guys' stocks, like Amazon. Incredibly exciting story, and like I guess it's no longer Bezos; it's now Andy Jassy. I don't know if they're still saying it's still day one. Maybe it is day two now, but like there's still a world of growth ahead of
If
them.
I may ask, what's wrong about boring?
No, yeah.
I have a polemical answer to that, which is not, from what, it's intended to kind of prickle feathers, but I could think of two things. One, as we talked about, one reason people learn to invest and stay in the game is because they learn about the world, and it's just like and if I'm investing in, I don't know, 3M and bandages, what was true 100 years ago is true 100 years later, and it's just about the dividends of money, and that's doesn't necessarily.
Well, no, I disagree. Sorry, 3M. I mean, look at their patents and everything that they're inventing.
Bad example. Bad. Pick something like
Go
Coca-Cola.
on, give me another three.
a bottle, right?
Hey, we have a
but I
bottle
think
cap now in the EU that is stuck there, right? So another
yeah,
invention.
uh, but I think the other potential trap has to do with company life cycle, and that you only get to dividends after you've in essence become a mature company. But in the age of AI, things are being disrupted so quickly and readily that I fear that a boring, in quotes, approach might lead to a kind of complacency, and before you know it, you're the next Kodak, where things are fine and then all of a sudden you don't exist. um, so more fun, less fun, you learn less, and then death all of a sudden.
Yeah, maybe, but that's interesting that you say that, because you suggest that, because I was looking at this, Chamat Palil something, right? He is announcing another spec again, and I saw the performance of his last 7 specs. Only Sophie is in the plus, all early stage companies, and the rest is like 50 to 80% down. So talking about companies not existing anymore a few years later, I think there's a higher likelihood for a slow compounder to still exist 10, 20 years than the early growth stocks.
Yeah, that wasn't the kind of fun Christoph's hoping for when he holds these companies. The fun of jumping out a window. Yeah.
Yeah.
Well, should we let's turn it on to psychology a little bit,
Yeah.
because when we came on your podcast, I mean, ostensibly I came on to kind of talk
Yeah.
about how I managed to fund my lifestyle, and I do that by
Mhm.
having like a cash allocation. But you've told us at the top of the conversation, you live off the income
Yeah.
and you're tracking it. I love the idea of your like 80% tracker, and we're looking forward to hearing when you get to 100%. What is the psychology though of living off of income and like
Yeah.
replacing your active income with passive income?
The psychology, I mean, just this kind of feeling when a dividend comes in.
Mm.
I wish I could configure it in my broker that it says ka-ching. Just when you're working and you hear on the background ka-ching, ka-ching. I mean, you can't describe it, but it gives me goosebumps already. Yeah, this is a feeling. I mean, and then I went to America in June. I went on stock safari. I went with a friend. We went for 2 hours just walking through the targets like kids in a candy store. We were like, "Wow, look at this here! Look at this! Hey, and why have they everything behind the glass? How stupid they are! I'm a shareholder. We should talk to the boss here, right?" So the stock safari as well, and I think we were also chatting a bit with Greg's, right? Yeah, it's hard to describe that, but you become, and I think that's what you alluded to, Christoph. You become more aware of the world, you learn around the world, but just this thought that there are like millions of people on a daily basis just working for me to make me wealthier. I mean, yeah, that's how I feel. I mean, it's just an income machine at this moment, my portfolio, and to see that coming in, knowing that I'm buying freedom back with this, is just, yeah, it's just a dream.
Yeah. And just to round out this conversation, I think people get in trouble when they solidify too much around a particular identity, in which case here we're talking ideas, right? So we're workshopping things. But in all transparency, I think if to make your point, I think if quote unquote boring works for you and it feels satisfying and it makes you money and you could generate excitement within that world, by all means. If it's I'm learning a lot in this conversation because at some point I might say, okay, let me throw in one dividend investment and let me examine how boring it actually is to own it. I'm guessing ahead of time that won't be boring at all. It's just such a contrast to typical styles. So my invitation to all our listeners would be, examine your own inherent biases and assume that they're incomplete, whether boring or exciting or whatever.
It's very interesting because what is for you boring may be for me very exciting, and vice versa. And that's why society is so diverse. Otherwise, we would all like the same football team. We would all like the same sport. We would all like the same brands. And we don't, and that's why there's so much diversity. Yeah, and I think that's what it is. Some people like collecting post stamps, otherwise like others like to sit behind a slot machine, others like to invest in their wife. Yeah, there's so many ways you can spend your money and get joy out of things. So
That brings us on to like a nice kind of lightning round we'd like to do with you before we close out our conversation today, because you're right. Some people like some things, some people like other things. So we've got a overrated or underrated lightning round for you. We'll hit you with a couple of investing topics. Give us your dividend investing perspective. I'm not into these. I don't know too much about them, but overrated or underrated REITs, real estate investment trusts.
I would lean towards overrated. You want to know why?
Sure.
Sure.
Very
Yeah.
lightning.
Sure. Yeah.
Yeah, I think too many people are solely in it for the dividends, but this is one of those industries where dividends really quickly get cut because of leverage. I think for realty income, I own a lot of that, but I'm much more a fan of Agree Realty. And I would really suggest to just read one of the reports of the CEO. For instance, it's really nice. He's actually having pictures in there how he started to move away from having Walgreens as a customer and taking very much pride in his calls about saying, you see, this was a dying business. I saw it. I got away from my tenant. Yeah, but generally, I would say REITs are more on the overrated. I think generally too much risk in there.
Okay. How about share buybacks versus dividends?
Yeah, I would go for dividends. Dividends have over history proven to be more reliable than buybacks, and also buybacks are typically done at the top, which I really dislike.
How about ESG investing, environmental, social, and governance investing?
My God, that's overrated. I mean, have you read once such a social report from a company of 200 pages? Try it. I mean, it's horrible. And you know what it does? It creates friction for people that really want to live in a better planet. For me, it's a lot of window dressing only to satisfy the activists and to keep them quiet. I do care about the planet. I do want a better planet. Yes, I have a lot of oil. Why not get some cash flow for it so they can buy solar panels? Yeah. But ESG investing, when you stop with that, for me, a company really I would love at least companies to go back to people, planet, profit. Yeah, something like that, having that a little bit. But I'm so tired of companies mostly communicating towards activists and forgetting about shareholders. I really am pissed off with that. It's my money. You work for me, not for an activist. An activist is just a flea in your skin that you want to get rid of.
Oh, we're quoting that. That's going viral. That one. How about you mentioned Meta earlier in this conversation? I'm very curious. Max 7 stocks. Where are you at with those?
Oh, that's a difficult one. May I say it instead of overrated, underrated? May I say like overhyped on the short term, underhyped in the long term?
Sensible answer. Sweet. Would Meta be something you're currently
No, I sold.
interested?
I bought at 150. I sold them at 500 because I allocate 10,000 euros in my portfolio for a bit of growth, more in my circle of competence of IT. And Meta, it went too far ahead of itself. I think I mean, their ad revenue, I think, is a little bit at risk with people starting to disengage. They are farming a lot of engagement. I wouldn't be happy with an advertiser, I think, at times. Yeah. So not a business that I have a lot of conviction in.
That's fair. And yeah, we're a bit on the fence about the Mag 7, but I'm going to close us out with the big one because we're both in the US right now. I'm visiting Boston, and we're US investors. Overrated or underrated US stocks?
Underrated. I have 55 to 60% of my portfolio in US dividend stocks, and the others are in Europe. Let's face it, I would never bet against America, even with their debt pile. I think there is a certain level of greed in there, and their world dominant power. They will make sure that the money flows into that country and to their companies. It would be, I think, unwise to bet against that.
I like your stock safari comment because I'm out on safari this afternoon. I'm going out with a buddy. I want to go and check out a Carver. I want to go and check out like a Sweet Greens. there's a whole bunch of retail brands I want to go and look in the window of and see can they really justify their crazy valuations.
Exactly, and talk with some people that work there. Very enlightening. Nice. Yeah, I would recommend everyone to do that. The risk is that you fall in love with a stock and that you get blind because of it. But for me, when you're in Europe and not that much in America, and you hear the stories about loofing and everything in California, it is good to go yourself into a retail that you own and just check out how bad it really is.
Gentlemen, I love this conversation, and I think there's many more follow-ups. There's so many threads that we could go much deeper on. I'm in the moment, though. I'm thinking an interesting challenge for myself. I don't know if you're on board, Badger. Is what would it take? What would happen if we did like a portfolio uh, kind of not switcheroo exactly, but best argument for swapping one of my growth stocks for one of your favorite dividend stocks and vice versa? Like, what would it take to convince, to make the swap? And maybe we explore something like that on a future collaboration.
Let's do it. In the last podcast episode, Derek was roasting my portfolio, which was also interesting. So he discovered as already a sneak preview that I still have some Alibaba in my portfolio. So, and I think he kind of reminded me that probably it's a good time to sell it, and then it will go 5x.
No regrets.
Exactly, but it may also be a buy signal for one of your listeners.
Hey, great stuff. Well, this has been a fantastic conversation yet again, and I'd love to do a part 3 at some time on either your pod or our pod or someone else's. But before we close out, remind our listeners where they can find you guys on social media and on the podcasts.
So I think the easiest is to go to my Twitter profile. It's European_DGI. You will find me there. Other than that, we have a Facebook group. We have recently opened also a Discord group. I can share the links with you. And then on my blog, europeandgi.com, where there's a lot of content. I mostly try to inspire people just about the journey of investing, but also a lot of stock examples that you find there. I'm mostly known, I would say, for the Noble 30, which is an index of 30 European dividend growers that I compiled because such a thing didn't exist. So when I started in 2020, I analyzed 200 companies and 30 came out of that with a growing dividend. But not so much assessing the quality, but more the history of the dividend. So yeah, that's where people can find me. And just shoot me a direct message or something if you want to learn more.
Great stuff. And we'll drop links to all of that in our show notes for today.
Awesome. Thank you. It was a pleasure from my side as well. I think people feel it, but there's a bit of chemistry here. I think we all have this kind of distance to investing as well, that we can have fun about it and also can have fun about ourselves a little bit, right? And I really love that. Sometimes the stuff on the internet is way too serious. And that's boring.
And we do have to have our listeners come on and pick our scabs and remind us about our mistakes of the past. So, just to face it. Yeah.
That's what those listeners do to us. How bad.
And while we have you here, Edgi, one thing you may wish to do is perhaps take a look at our Patreon page, patreon.com/Wall Street Wildlife. We have pinned at the top our portfolio tracker, the stocks that Badger and Monkey run transparently with each trade. And I wonder what would happen if you took our mutual portfolios and, workshop them on your podcast, and what kind of flaming fireballs of
I think I first of all need to go to the library to discover what those companies actually do.
It won't be the library for Christoph's one. You'll be looking at the kids section in the bookstore.
Yeah, no, but I think that's a nice topic for our next time. So when Derek has some time, maybe towards the Christmas or something like that, why don't we just do like what I did with Derek yesterday? We roast each other's portfolio and swap some stocks out. Yeah, then we have 4 portfolios to go through.
Fantastic. Great stuff. Well, thanks again for coming on the pod. Really educational and interesting for Wall Street Wildlife listeners.
Thank you so much, guys. And keep on going. I love it.
Awesome.
Woo, 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 woo.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.